Dividend investing, one of the most popular ways to invest in the stock market right now. And it's popular for a good reason. In fact, the reason that dividend investing is so popular is because it allows investors two ways to make income. With dividend investing, you can profit from regular dividend payments that you receive on a regular basis from the companies you invest into, as well as stock appreciation over time. And the cool thing about dividend stocks is they are great for having true passive income. In fact, with dividend investing, you can literally make money while you sleep. In fact, this is one of the reasons why I first started investing into dividend stocks, is to be able to get that regular payments on a monthly basis and supplement my income. Because at the end of the day, who wants to work more? I think we can all say we'd rather work less, but still earn just as much money. In fact, even earn more income over time. The greatest thing about dividend stocks is that you can reinvest those dividends that you earn on a regular basis, and those earnings will compound over time and allow you to make even more money. In today's video, we're going to be talking about dividend stocks. I'm going to give you guys some tips and really help you guys if you are completely new to investing with dividends. My name is Robin and welcome to my channel. And if you guys do enjoy this video, be sure to give it a big thumbs up. And if you guys want more dividend investing based content, be sure to subscribe to the channel. All right, so I gave you guys a quick little introductory to dividend stocks, but the real question we have to ask ourselves is why choose dividend stocks over other forms of investing in the stock market? Now, the main reason why people pick dividend stocks to invest in the stock market is because dividend stocks allow you to invest, but also earn income and really reduce your risk in the stock market overall. And the reason why this happens is because not only are you earning income from stock appreciation, you're also getting regular dividend payments on a regular basis. Now remember, not all stocks in the stock market pay a dividend, so you're kind of at the mercy of that stock growing in appreciation over time. Now, what happens if your particular stock you invest into does not grow over time? You actually lose money. But the nice thing about dividend stocks is even if your stock does not grow, or let's say it has a not so great year, those dividends that you get on a regular basis will bump up your return at the end of the year. This is why dividend stocks are so attractive for new investors. In fact, I love dividend investing. I did a dividend investing case study on this channel where I built a dividend investing portfolio completely from scratch. You guys can check that out if you want, but I love dividends and I started dividend investing because I wanted a way to get income on a monthly basis that was truly passive while reducing risk in the stock market at the same time. To give you guys an example of how this might work, let's do a little bit of math. Let's say you bought 10 shares of a company at $5 and that company pays you an annual dividend of 0.15 cents per share. At the end of 1 year, you would have $50 and you would have earned $1.50 in dividends. That's 3% yield just from dividends alone. A 3% increase at the end of the year from owning a stock is not too shabby, especially if that's just from dividends alone. And the cool thing about dividends is you could do whatever you want with them. You could go buy a cup of joe, or you could reinvest them back into your portfolio and earn that sweet, sweet compounding interest. Now, the best part about dividend investing is the predictability that it allows you to create in your portfolio, especially if your portfolio is made out of a big, large collection of well-diversified dividend-based stocks. For example, you can buy one share of an ETF that's based off of dividend stocks. You now have hundreds to thousands of stocks and all kinds of different sectors and all kinds of diversification just for one share. Talk about investing being easy. Remember, dividend investing and just investing in general doesn't have to be complicated. In fact, I like to keep things simple. Investing into ETFs and other types of index funds are a great way to diversify and build a nice solid portfolio. And if you want to invest in dividend stocks, there's hundreds of different ETFs that are based out of dividend stocks. The trick is to pick one that has a solid base of stocks and has performed well over a long period of time. Now, long-term stock growth and dividend growth is one of the best ways to earn income just in general with the stock market. However, when it comes to dividend investing, the real key is to invest into companies that have shown that they regularly increase their dividend and they keep that dividend, and also the company's overall stock price tends to increase over time. A perfect example of this is well-known companies like Pepsi or Coca-Cola. These stocks, these companies have shown to increase their dividends over a long period of time as well as increase in value, and they've been around forever and they've continued and they still continue to do well even to this day. These are the type of companies that you want to hold inside your dividend-based portfolio so you can guarantee that you earn income over time from your dividend-based stocks. Now, before you go out and you buy a bunch of dividend-based stocks or you buy a bunch of ETFs that are based out of dividend-based stocks, here's some things that you need to remember. Remember, this doesn't have to be super complicated. You could go the ETF route, buy some dividends, and you'd be doing pretty good. But if you want to pick your individual dividend-based stocks, and I recommend that you do kind of buy some stocks yourself because it is quite fun and it is a nice way to build a portfolio that suits your needs, there are some things that you need to keep in mind. So let's go over some terms and let's kind of talk about some things you need to look for when buying dividend-based stocks. So the first thing we're going to be talking about is the dividend yield of a particular stock. The dividend yield is basically the annualized dividend return at the end of the year. A higher dividend yield or percentage means that that stock company is going to be paying out more money, but remember, it's more important for that company to have the ability to sustain their dividend over time instead of having a really big high dividend yield. While a dividend yield of 8% might seem really nice, remember a dividend yield of 4% might be a little bit more safer and actually show you that a company is more interested in growing and investing in itself instead of paying its cash to its investors. Generally speaking, you want to look for a dividend yield that is around the 3 to 5% ratio in general, but keep in mind some stocks and some industries tend to have higher dividend yields than others, such as REITs, for example, tend to have a little bit of a higher dividend yield than regular stocks. The next thing we're going to talk about is the payout ratio. The payout ratio is the dividend in terms of the company's overall income. In general, the lower the payout ratio, the better a company will be able to sustain its dividend, because the lower the payout ratio, this basically means that they're choosing to invest more money in themselves than pay it to their investors. If a company has a high payout ratio, that means that they're giving the bulk of their money to investors. Now, this might seem good in the short term, it actually hurts the company overall because they're basically giving their money away, and this can create problems. It can sometimes be better, and most of the time it is better, if a company keeps most of the money for itself, invests into itself, and then over time increases its dividend to investors in small amounts. Generally speaking, you want to look for companies that have a lower payout ratio, as it's an indicator that the company is serious about itself and can sustain its dividend in the long term. Cash payout ratio is very similar to payout ratio, except for it basically tells the cash flow of the company. Generally speaking, once again, you can use it in combination with the payout ratio to determine how sustainable dividend is, and if a company is investing into itself, and of course having more cash flow coming into the company is always a good thing. Next thing we're going to talk about is the total return, and this is the total return of a stock at the end of a given year. So if you have a stock with a dividend yield of 2% and then they have a stock appreciation of 8%, the total return at the end of the year would be 10% for that stock. Now, I just wanted to briefly talk about these terms, but don't worry if you don't understand them. As a beginner investor, it can be a little bit confusing, and there's a lot of different terms that people use out there. In fact, I'm still learning dividend investing myself, and a lot of this stuff I'm still learning as I go. And you don't need to know everything at first to get started with dividend investing. And this is why figuring out the right approach for yourself is often the best way to do it. And last but not least, I want to talk really quickly about the earnings per share. Generally speaking, you want companies or stocks that have shown to increase their earnings per share over time. This basically means that they're growing their dividend over time. A company that increases their earnings per share over time has shown that they're able to sustain and increase their dividend and pay it out to their investors. Always a good thing to look into when it comes to picking a company to invest into. Now, the next part of the video I want to talk about is high yields, because one of the biggest mistakes that investors make when it comes to investing into dividend stocks is chasing stocks with high yields. Now, high yields aren't just necessarily a bad thing, it really just depends. But remember, whenever you find a stock with a really high yield, sometimes it can seem like it's too good to be true, and it generally is. However, these are some things that you want to keep in mind when you assess a stock with a very high dividend yield. First of all, look for metrics and compare a stock's history if you're dealing with a stock with a very high yield, so you can get a sense of value and how sustainable a stock is going to be able to basically sustain that dividend over time. Remember to use the payout ratio and the cash flow ratios to see how much money the company has come in versus how much money is going out. Remember, lower payout ratio means that a company will be able to sustain their dividend in the long term, and you want companies that will sustain their dividend. It's kind of useless to have a company that has a high yield dividend if they're not able to sustain it, because you will just lose that dividend in the long term and you'll make less money. Remember, generally speaking, lower payout ratios are better and often ideal. The next thing you can do when dealing with high yield dividend stocks is to look at balance sheets, look at liabilities, look at debt, look at all that kind of stuff that might factor a company's ability to stay afloat. Of course, generally more debt, more liabilities are generally a bad thing, but if a company has different assets or different things working in their favor, that can help also make a company a better investment in the long run. Last but not least, one thing I like to do, and this is one of the biggest things that I do, is to focus on the business itself. Is the particular stock or company rising? Is it gaining in popularity? Is it something that's in high demand? If it is, then you can also look at this and be like, well, if a stock or a company is in high demand, then chances are it will do well in the future. For example, companies like Clorox right now is something that's in very high demand. So this company would probably be an amazing company to invest into right now because there's such a demand for it. It's almost impossible for it to grow over time. However, keep in mind, it's always important to look at the metrics and pay attention to how well the stock has done overall and how well it is probably going to be doing in the future. And when it comes to high yields, I generally avoid high yield dividend based stocks because I think they're just too risky for me. I would much rather take a lower yield dividend based stock like a 4 or 5% or even a 3% dividend yield if that company has shown to increase its dividend over time, and it's basically a safer bet. I will take lower dividend yields with long-term increases and the ability for a company to maintain its dividend yield in the long run. Because remember, guys, what the long term is the most important thing. You want stocks that will be able to increase in value over time, increase their dividend, and basically keep growing forever. I prefer to focus on slower, longer sustainable results over time. Alright, so the last thing we're going to be talking about today is whether or not dividends are taxed. Now, generally speaking, when it comes to dividends, yes, dividend payments are generally taxed, and how much they are taxed depends on two factors: how much money you make per year and where you live in the world. However, it really depends on the dividend stocks and where you live, because some dividends will be taxed at a lower rate, while other dividends will be taxed at your marginal rate. Once again, it depends on what these kind of companies are and whereabouts you live in the world. However, none of this applies if you actually have a tax-free savings account and if you put your dividend stocks inside of a tax-free savings account. For example, I'm from Canada, and in Canada we have a tax-free savings account that allows you to invest into dividend stocks and earn those dividend payments tax-free. Therefore, any stocks that you invest into that are Canadian-based will be 100% tax-free. Now, if you do invest into foreign stocks, you will get taxed on those dividends, but the opportunity when it comes to stock appreciation of those stocks will be 100% tax-free. So it really depends on where you are, but you can knock out a lot of taxes by investing your dividend stocks into some form of tax-free savings account. Now, in order to sum everything up for this video, I just want to say that dividend investing is one of the best ways to grow your nest egg and supplement your income, regardless of how much money you make. Because in the end, who wants to work more and who wants to spend more time working at their job? I, for example, started investing with dividends because I want to make more income as time goes on. And as I get older, I want to spend less time working and more time on living and doing the things that I enjoy in life. So if you are brand new to dividend investing and you're watching this video and you want to get started, then I invite you to join me on my journey. Check out my dividend investing case study where I built a portfolio completely from scratch. I'll put a link to an end screen in the top corner here. You can click that end screen. That'll get you started on the playlist, and you guys can watch how I build a dividend investing portfolio completely from scratch. Otherwise, guys, here's the end of the video. Thank you guys for watching. If you guys enjoyed this video, please give it a big thumbs up. And if you guys want more videos based about dividend investing, please subscribe to the channel. Thanks for joining me today, guys. Thanks for watching, and I'll see you guys later.